The fund has been really consistent in performance. Yes, we understand from you that cutting average maturity and adding average maturity at the right times is what actually has helped the performance of the fund. How are you able to do this consistently?
So average maturity plays a big part of it.
Mhm.
But it's not just the average maturity. There are other things like how you bucket the maturities, what positions you take at what time. So there is obviously seasonality involved in the rates. How you take in terms of the flows that you get in your fund. So there are a lot of other things as well. Demand, supply, spreads available at that point in time, and those all contribute to your overall return.
So, what are those key two factors or three factors which help you decide which maturity bucket to go overweight or underweight on?
Spread is one thing I think that remains a central part of spreads can be yield spreads can be various instrument spreads, for example, NBFCs versus CDs, CDs versus treasury bills. Within treasury bills, you have like whether you want to go 3 months, 6 months, 1 year. So within each of this, there are decent amount of spread combinations which are available and how you want to use them in order to keep liquidity also of the portfolio at the optimum levels and at the same time take advantage of falling yields in a particular bucket as you.
What is the extent of overweight that you could go on a maturity? 3 months, 6 months, 9 months?
So again, I mean, it really depends. I mean, which part of a year you are setting, that determines, I mean, which kind of month maturity you will pick up. You're setting in the final quarter, it's 1 year. But when you're coming in the month of April, for example, at that point in time, you need to kind of, ascertain how you see the spreads.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.